Alrighty. Good afternoon, and I think the AltFi guys know they put Stuart before a beverage or food service, otherwise he sits here for hours. Quick introduction. So I've got my MoneyPlace hat on now. So Stuart Stoyan, founder and CEO of MoneyPlace, marketplace lender in Melbourne, providing personal loans. We'll just do a quick intro through the panel in sort of 10 or so seconds each. Then we'll get into an exciting discussion.
Hey, Matt Leeburn, I'm the Chief Commercial Officer at Moula.
Richard Williamson, I manage our offshore products and sit on the investment committee for CreditEase, a privately owned Chinese P2P and wealth manager.
Hi, I'm James Boyle. I am the CEO of Liberty.
Hi everyone, Simon Dennis, and I'm the Head of Partnerships at MYOB.
So we're talking about today who needs a bank anyway, and two of the panelists here kind of have done that and partnered with Liberty. So the full disclosure is that Liberty is a partner and investor in both MoneyPlace and Moula. So I'm going to start with a question to Matt and just say, we're kind of inked and we're in, but how's the relationship with Liberty going, and is it something a company should think about doing?
Absolutely. I mean, I've only been with the business for about 11 or 12 months now, but in that time, I think Liberty has been a hugely beneficial relationship to us. It's almost as if we've kind of adopted this wise patron that, Liberty have got 20 years of experience and have been incredibly successful and have probably made some mistakes along the way, and we've been able to benefit from the experience of James and his team, which has been fantastic.
I guess to then follow up, James, with that, from a Liberty perspective, aside from looking for good-looking founders, what's the sort of criteria that you use in selecting these companies to partner with?
Yeah, good-looking founders is important. We haven't managed that one yet, but
that's why Aris is not on the panel. We got Matt instead.
It's been an interesting journey. So, not so long ago, although 20 years sounds like a long time, we used to fancy ourselves as the startup, but we've made our fair share of mistakes over the 20 years and had our fair share of success as well. And a lot of it is based on being really clear about what we want to be doing for customers and being very open about learning as we go. And so when we got the opportunity to engage with two very high quality startups in the case of Moula and MoneyPlace, there was one fundamental that had to be in place for it to work. We shared a common ethos. All three companies have invested significantly in risk-based pricing technology since they started. So that was a great foundation and really, really important in our case. Why was it appealing then for us to work together? Well, actually learning was a big part of it. These guys are newer, brighter, and embracing more recent technologies than we are. And although we run all of our own tech stack that we built from the ground up, we're always looking for opportunities to improve it. So that was one dimension. But a second really important dimension too was really laser focus engagement of a crack management team on one specific part of the market we were wishing to address. At Liberty, for a long time, we've talked about helping more customers get financial. We're very clear about which markets we choose to operate in and those that we don't. And in both cases with Moula and MoneyPlace, they were making great headway in markets that we were already active or had aspiration to be more active in. So common ethos, really solid management team, and the ability to learn together were the three elements that were really key in both cases.
And I think to add to that, from a MoneyPlace perspective, that definitely resonated on the other side. I spoke earlier in the day about customer outcomes and what we need to do as an industry around driving better customer outcomes. It was clear that that was a focus at Liberty for us, and so that common ethos was really core. We sort of came away from the first meeting going, this is something that a partnership that could work, and that comes from a base level understanding. And I'd call that out to any sort of fintechs that are in the crowd that are contemplating partnerships or about to enter partnerships, is that core DNA is very, very much tied to what are the values of the organisations, respectively, but also do you have that common understanding? Because if you're then trying to head off in a different direction, then that's not going to work. If we throw to MYOB, from a very, very, I guess, a similar sort of perspective, but slightly different. You guys have done something where you've partnered with an overseas company. Do you want to just talk us through some of the thinking behind that, and then also the fact that you guys have got slightly different sort of products in market as well?
Yeah, absolutely. So I'm not sure whether everyone does know in the room, but MYOB is a 30% shareholder in OnDeck Australia. So, we really view that as an investment partnership rather than just your typical commercial partnership. And I think that's really important. But before, I think it would be good to explain the why MYOB and OnDeck. And I think we've got to go kind of back to the MYOB side to understand, why we've evolved and changed over time and why this was such a good fit. So, MYOB has been in business for 27 years. Obviously, we exist to help businesses be successful. And we not only do that for end user clients who use our software to power their business, but we also have the majority of accounting firms and bookkeeping practices around Australia that use our practice solutions to power their practices. And so then you've got effectively clients who trust us with their data and trust us to help them be successful and keep them compliant. And on the flip side, we've got accountants and bookkeepers who trust us to provide solutions that help them give great advice to their clients. And so one of the common things that happens when any small business goes and sees an accountant is they're discussing financial advice. They're talking about the problems within their business. They're talking about cash flow. They're talking about, their position and what's going right and what's going wrong. And so the common discussion continued coming back around to, I've got an issue, where do I go to get money? Or, who do you recommend? Or do you work with anybody that can provide me a lending solution? And so as we've moved into being an online business, and it's really important, I know we often get referred to as an accounting software company, and traditionally we are an accounting software company. We haven't actually been just an accounting software company for many, many years. We've got about 13 or 14 different streams of solutions or segments of product that we offer our customers, and that's really about having the broadest range of solutions that again helps them be successful, whether it's online payments. We're about to release probably the broadest range of payment solutions to market after our acquisition of Paycorp, and we're also offer ERP solutions, and the list goes on and on. But the one that we didn't obviously have was a lending solution, and so we saw what was going on over in the United States and saw the amazing work that OnDeck were doing with one of our competitors over there, by the way. But they had a very different partnership model than what we've obviously created here. And so we decided to make that acquisition, the 30% acquisition. And that was really about making sure that our businesses are 100% aligned in everything that we're trying to do. So we don't treat ourselves as separate entities. We work very closely with the OnDeck team. We've got them working out of our offices in some state markets. And really what this was about is offering the best possible solutions to our customers and a range of customers that aren't yet our customers to make sure they're getting the best customer experience possible. And again, aligning with our vision, which is to help businesses succeed.
Awesome. And then to sort of throw from Richard, so with a China and a broader international perspective, keen to sort of hear your thoughts around this, because I think it's fair to say that the China guys are absolutely crushing it, so CreditEase in particular, but also others as well. What is it that's specific about sort of non-banks and that sort of DNA that's enabled partnerships to happen in China?
Yeah, look, the Chinese market's very, very different, and I think for a lot of the groups that people here might have heard of, they've really sort of leapfrogged past the banks. I'm not sure how much of it's relevant to Australia, but some of the groups that people might know about, Ant Financial is a subsidiary of Alibaba. It started as a payments business, and now it's a broader financial services business. It has 400 million clients, and it has the biggest credit bureau in China. So, it has this incredible ecosystem of working with other fintechs and so on, and it's really leapfrogged the need for banks. Now the banks are coming to Ant to actually use the credit bureau. So it's a business. They're doing a fundraise at the moment. It's rumoured to be at a valuation of $150 billion US. I mean, it's just leapfrogged past the banks in so many ways. Lufax is another one that people might have read about. There's an expectation it will come to market sometime this year with a valuation of $60 billion. Again, 400 million clients, and it's a business that grew out of a traditional financial services company. Now owns a bank, owns its own insurance company. It has this cloud-based enterprise solutions suite of services and products for banks, and has 400 different bank clients. So, you know, a recurring theme in China around these groups are they've managed to build on an existing client base, you know, really zero down on one piece of capability that's excellent, whether it's digital payments or whether it's online P2P selling, and then work with others to really leapfrog past the banks. And the bank collaborations now, frankly, you've got that nice dynamic where the banks are coming to Fintech players rather than Fintech players going to the bank saying, you know,
which is
we need your
absolutely
clients, we need your funding or whatever.
Which is absolutely the way it should be, right? I mean,
Of course.
And I mean, what's also interesting about Ant is Grab, the sort of taxi company or ride-sharing company in Southeast Asia, announced they were moving into financial services and they were partnering with Ant. So that's sort of phenomenal to say that, you know, this is a company that then bought out Uber's Southeast Asian operations, doing these partnerships. And as a financial services partner, they're partnering with Fintechs, with Ant, as opposed to a traditional bank. So question then to the panel is some great examples here. You know, what is the opportunity for non-banks and Fintechs to be able to partner? And are there any limits to that? If anybody's got a...
Yeah, I'll take a crack, Stu. I think for us, when we look at these partnerships, there's a couple of dimensions that have to be there. The first is that the fintech that we're looking to partner with is, we have confidence that they're going to be successful in isolation. So they're already on a trajectory such that you can see a very clear execution path and good ground made along that path, and a very clear proposition for their customers. So that, you know, that's a must-have. Then from our perspective, there needs to be a synergy. You know, there needs to be a reason why that can be accelerated and why we can be more successful together than apart. And I think that's key, right? Understanding exactly how it is that each of you can come together and create more value than you're creating apart. If that's not really, really clear, then you're probably trying to create something that doesn't make a lot of sense. You know, in the case of Moula and MoneyPlace, we had good technology infrastructure, sure, but so did both of you. What we probably had to offer the relationship was strong funding background and good treasury skills, and the ability to work together quickly to learn and innovate and evolve the customer proposition. So it was very clear to us that working together, we were going to cover ground quicker than either of us would cover independently. So I think when we look at these success stories, they've all got that element of it makes more sense together than apart, but the two propositions are fundamentally successful anyway.
Yeah, so I think we see the opportunity as massive, which is one of the reasons why this partnership with OnDeck makes so much sense. So the reason we see it as huge is, you know, data tells us that around 80% of small businesses can't get money from a bank today. Now, if you run those numbers over our, say, 1.2 million small business customers, that's a pretty attractive number on one sense. From a commercial standpoint, it's a bloody huge problem. On the other hand, for businesses who will live and die by having access to that funding. You know, and that's a very, very emotional discussion internally, because again, you know, we're only successful when we're helping our clients be successful. So there was a couple of things that I didn't say in regards to the reason why we believed OnDeck were the partner of choice for us. So when we did our research over in the States, and you know, for those of you who are very familiar with Net Promoter Scores, the Net Promoter Scores off all of the lendings that OnDeck had done in the United States was just off the charts. So, you know, they were sitting up around the 74, 75 mark. And when you're talking 74, 75, you're talking Google, you're talking Apple. I mean, that's a pretty irregular number for anyone in the banking or lending sector. So what we've actually seen is, since we've partnered with OnDeck and brought that MYOB loan solution out to market here in Australia, I never thought we would beat those kinds of numbers, but what we've seen collectively with OnDeck is we are tracking at around about an 83 and an 84 from our own customer base. So they're telling us they absolutely love it, and they're telling us that they trust it. And just to give you an idea of why we think that is, I mean, we're in an age of immediacy where people are looking to have data accessible at any time, and they're looking to be able to make decisions in real time, and that's just the nature of, I guess, working in the tech space. But what we're seeing is that the demand for service, support and customer experience right now, the point of difference that we see organisations are going to have between one another, it's not necessarily how much money you can save if it's $100 or $200 here. Service and support is absolutely going to be a key differentiator. If you don't mind, I'll just give you one example of a customer that we had on 2 days before Christmas. I had a customer contact me or a partner, a bookkeeper over in WA who had a massive problem. She said, look, I've got a client who needs $150,000. Can you introduce me to the MYOB Loans partner team? We did that. Within 24 hours, that $150,000 was in the bank for the client right before Christmas. And that was to purchase a whole bunch of machinery that they needed through coming into one of their busiest parts of the year at the start of the year. But what was the most important thing for that bookkeeper was the fact that she was able to call a real person, and that person was answering the phone on the 3rd ring when it was a very hectic, stressful time. And so, yeah, we see that the opportunity is massive, but it's those that are going to deliver on their value proposition and really look after their clients that's going to be the long-standing winners, in the way they run their strategy.
Indeed, and I think sort of following from that then is from the sort of fintech sort of side or the investee, and there's a question that's come up that sort of ties to this a little bit, which is about how do you navigate the conflicts of an investment partnership. So Matt, if you want to sort of talk to that a little bit, and what's been the relationship like with a benevolent corporate partner?
Bow down. No, look, I think the sad reality is that most partnerships don't work out in the end. There's a lot of literature and Harvard Business Review that covers this topic. To James's point before, you must be truly aligned for it to work. Otherwise, I think if you don't have mutual benefit, you have mutual destruction. I think where we sit at the moment, being very focused on the small business unsecured space, we're a perfect fit for the Liberty family. I think, if I told James we wanted to get into consumer, we'd probably be having a very different conversation. So it really just comes down to kind of, I guess, knowing your place in the family and knowing what we can do together rather than trying to, create something that's not going to work.
Yeah, I think from a MoneyPlace perspective, while sort of only a few months into the relationship, we've found that it's an excellent sounding board for people who've been doing this for 20 odd years, but ultimately there's an alignment of interest there. So MoneyPlace interests are core to the overall relationship as well. So we've been supported and promoted on that. So it's not necessarily that there's a conflict of interest. We still have other investors who invest through our platform and are funding loans. That's not been an issue, and I think to James and the team's sort of credit, there's been a sort of self-awareness there of a healthy, thriving MoneyPlace is actually a good thing for everybody. We don't necessarily have to have it all. There's another question that's then come up, which sort of is an interesting perspective on that. So if a fintech wanted to partner with somebody who was a competitor, how would you guys then manage that sort of situation? And James, maybe initially, given you've got two of the panelists here that sort of fall into your domain.
Yeah. I think I will answer that question. I just wanted to add a comment to the previous comments, which is, from our perspective at Liberty, we respect these businesses because of their independence. We want them in the group because of the independent thought and focus that they bring to the group. So it would be foolhardy to, do a partnership and then start trying to force our thoughts into these businesses. That's a great way to stifle success rather than to create success. And that plays out as well in the way that we organise ourselves. So, it's always the answer, right? Good governance is a great way to combat bad decisions. So in both cases, there are independent boards. In both cases, the management team take their responsibility in engaging the board for the best outcome of their execution very seriously. So that allows us to make sure that we're not sort of foolishly embracing groupthink, and I think that's going to be very important for long-term success. So then, the follow-on question is, well, then how would that play out if one of the companies that we were partnering with also wanted to partner with, our competitors? This conversation comes up really early, right? And you're silly if you don't tackle it early, because it could be a sad shock for the partnership later on, and I'm sure the Harvard business cases that Matt talks about cover this. You know, we think it should fall down to the right economic outcome and the right outcome for the customer. And there is no requirement for any of the businesses that we partner with to use Liberty, you know, because Liberty is a partner. We're trying to achieve great things together. Now, the reality is if you get the partnership right, well, it kind of excludes your competitors anyway, because the relationships and the codependence become so deep that it's much easier for you to deliver those solutions together in partnership than to go and start engaging with your competitors. But, you know, very early on in both cases, we had the conversation and said, this has to make sense on standalone merits. It's not a matter of, well, just because we're working together, we're going to use each other. And, you know, it's nice at this stage to be able to say that that has been the case in all of the partnerships that we've had.
Richard, you were nodding along there as well. Anything to add?
Yes, absolutely. I think so for our year-end die, we have about 40 different partners, of which 39 are non-banks, and CITIC does our bank custody. But I think codependence is really important. The other sort of nuance or layer around that is how tightly your partnering is. So if you're a minority equity investor, and effectively it can look more like a commercial arrangement. So I think a lot of the hard work on partnering is actually done up front, making sure that the deal structure makes has enough flexibility to for a whole range of outcomes. It sounds grim and morbid, but building in divorce proceedings up front's really, really important. So you're not sort of hardwired where you don't want to be. And another element of it is making sure in that partnership, that both sides are executing to absolute best in class. Because what generally blows them up over our experience has been, you partner up with somebody, and then you realise 2 years, 3 years down the track, they're no longer best in class at what they're actually doing, and that creates, particularly if the deal structure's not set up well, creates all sorts of issues.
There's a question that's come up that sort of gets to, what are the risks around an investment from a major bank, or I guess from any investor if that comes through too early. What are sort of panel's perspectives around that? What's the right timing to invest? Maybe start with the investors and partners on my left side of the panel. James, yeah.
I don't think there's a single answer to that question. The right time is the right time for both companies. In the cases that, in the cases up here on stage, they were very, very different. With the Moula team, we were there almost on day one. The next investor in after the founders, and it was a very easy transaction to do because there was a great common perspective about what could be achieved and what we could do together. So we've been there for the whole journey, and then with MoneyPlace, we've come to the journey early in the bigger scheme of things, but late, in terms of MoneyPlace had been around for 3 years before we got together and found common ground. So I think it comes back to the comments that we've heard already today. A good partnership makes sense because it makes sense, because there are fundamentally good synergies that can be exploited, and a common ethos. That doesn't need to be on day one or on day 800. It's just at the time that both companies kind of have the motivation to get together and do things together.
Did you have a perspective?
No, I tend to agree with what was said there. No, I don't necessarily have any different.
No. There's an interesting question at the bottom here, which sort of talks to Moula's partnership with Xero. Do you want to just talk about that a little bit, Matt, and particularly in the contrast, because that's not an equity investment, but it's still a very, very successful partnership.
Yeah, that's right. So we use accounting data as part of our underwriting process. So we are partnered with Xero. We're also partnered with OnDeck with MYOB and Quicken. So we're quite agnostic to the accounting data that we bring in. So we consider our relationship just as strategic with MYOB as we do with Xero. So there's nothing that we're doing with these companies that other lenders can't currently do.
Yeah, there's a question that's been up here for a little while, Richard, just to throw to you around China. China seems to be crazy busy and these numbers are massive. Is that really true? Like, what's going on up there?
It is crazy busy. The question's about how reliable the data is. Some of the data points can be wishy-washy. You know, the one that everybody speaks about is that every year, if you look at the GDP growth from the 30 different provinces and direct municipalities, they tend to all be higher than the overall China GDP growth, which of course is mathematically challenging. But on the fintech side, I think they're genuinely and generally accurate. So we use. On the P2P business, you know, we all use bank custodians. Our subsidiaries listed on the New York Exchange, so you know, all of those disclosures are subject to certain rigour and so on. So I think on the fintech side, at least, people can accept with some degree of confidence the numbers, and fast growing and big.
Excellent. So just in closing, I thought it'd be useful just to go through each of the panel. We've got a great mix of both fintechs in the audience, as well as organisations that could partner with fintechs. So maybe just starting at the end, just a short bit of advice first for an organisation that wants to partner with a fintech, but also what's your advice for fintechs that would want to partner with you?
Yeah, so I guess I can only really answer it from the MYOB perspective, and that is that, you know, core values and business principles absolutely need to be aligned. You know, we're a customer-first organisation, and that will always be. And so if we have organisations wanting to deal with us where it's not, the focus isn't on the customers, but it's about their own growth, it's just not an area that we will go. Obviously, we've got an open access API that any business can go in and register for and interact with, and that's really where we have a few different tiers of partners. And so I talk about the invested partnerships. That's where we absolutely have that key strategic alignment, because we believe it serves a necessary purpose amongst our broader strategy. We've got our strategic add-on partners. I know add-on's probably not a great word, but again, that's still what I guess the industry is referring it as. And those are businesses that are really working very closely with us in our broader ecosystem, and we've got a team of dedicated partner managers and certainly marketing resources that will work with your brand to solve real business pain points. And then obviously there's that additional stream, which is where people can just integrate to the platform and run their own race, really. But I would say ensure that your values and your principles are very, very aligned, because what you'll get in return is the same that we expect from you, and that is a true strategic partnership.
Excellent. James?
You know, in terms of us, I think we're fortunate. We recognise that we're fortunate at the point in our evolution, because we are, as a partner, big enough to be helpful, but small enough to be nimble. And that's a real sweet spot, right? Because big enough to be helpful, meaning we can kind of bring some experience and a relatively mature platform of different competencies to the partnership, but small enough that we still make decisions pretty quickly. We've got, you know, I think cutting-edge technology that allows us to integrate really quickly. And so from that perspective, important for all fintechs is the ability to move quick, right? So that's sort of us as a partner, and why we think, you know, why we're exploring partnerships. I'd add, you know, partnerships take different formats. The two that we've talked about today happen to be equity, but we also have partnerships with fintechs where we're a customer. And it's, you know, as a customer, we've got like an inquiring mind. We want to solve customer solutions with the latest and greatest thought and technology. And so the advice for a fintech who's looking for a partner is, if you're really clear on what customer problem you're solving and how you're doing it better than everybody else, it would be crazy for any significant, you know, organisation not to want to engage with you about that. So if you can articulate that really well and find the right counterparty, then I think those partnerships happen pretty naturally.
My advice to fintechs looking for partners would be to just be super careful about which partners you pick, and I'm sure you know, the gentlemen here are great partners. With my fintech fund hat on, you know, we see a lot of deal flow from fintech companies that have taken on strategic investors and corporate venture partners and so on. And it's, you know, it's incredible. You look back, particularly in the US, where, you know, corporate venture's been around for a significant period. You know, different large multinationals and financial institutions and infrastructure providers and so on, over time can turn out to be great partners or not great partners. And, you know, it's amazing. You look at groups like City Ventures that have invested in a whole range of groups and helped them get exits and been very supportive. And then I could reel off, you know, a list of names of other, you know, partners and strategic investors and corporate venture groups that haven't added much value. So, you know, my advice would be to be really, really careful and do your diligence on, you know, exactly what your partners can bring to the table. And generally, exactly along with what you're saying, it's a lot more than equity capital. It's around alignment of interests and so on. So that would be my advice, diligence hard.
Yeah, I totally agree with that. I think, you know, when you're small, you can sometimes have a view that, you know, partner X or, you know, one of the big four banks, you know, if you get a partnership with them, it will make or break your business. I think we were incredibly lucky with Liberty. I wasn't around at the time, but I've heard that that was a very quick partnership from one of the founders of Moula meeting these guys to actually getting a deal. But we have worked with other partners trying to set up new channels for acquisition that we thought would be fantastic and, you know, really, really help fuel our growth. And we have spent so much time, so many meetings, so many flights, so many lunches, and they haven't got anywhere. So I think, you know, when you're small, I think you just, if you don't feel like it's getting anywhere, just give up because you're distracting yourself.
Indeed, and just sort of two perspectives on that is if you're a fintech, I'd say be honest and be really clear around what is it that you're struggling with and what is it that you're seeking out of the partnership. Too often I see fintechs that are trying to cover that up and, you know, oh no, we're going gangbusters and we're growing 10x each month. Be honest, because these guys are pretty mature and sophisticated. They're going to see through that. And then equally, or at least James hasn't seen through it yet, I should add. But then equally, I think from a partner perspective or a non-fintech perspective, is a quick no is much better than a slow maybe. Be really respectful of the fact that these guys have got a limited runway, not much capital, and a lot of fintechs and a lot of startups generally have sort of, you know, put everything on a relationship that's not gone anywhere. But we're out of time. Thank you very much to the panel. Great conversation, and hand back for announcements around lunch. Thank you, guys.
Cheers. Thank you.
Thanks, Stuart.